recording now. It's Friday, March 4th. So pull out this handout that I gave you guys, and we're gonna just kind of wrap up some information on Chapter 11, wrap up just a brief review, very brief review of stock splits, and then we're going to talk about retained earnings. And then I want you to also please pull out your course pack, and because I want you to look at the back of Chapter 7 in your course pack, and that is, I'm sorry, Chapter 11 in your course pack. We are going to be on page 85 in the course pack. Okay, so handout, get out your Chapter 11 handout, and page 85 in the course pack. And remind me on Monday, please somebody remind me on Monday about the textbook for Accounting 203, okay? Somebody, I need 2 volunteers to remind me of that so you guys don't forget. I need to tell you something about that book, but I'm not going to do it on Zoom. All right. Okay. So let's go. Let's take another look at the stock splits real quick. And like I said, they're not as common as they used to be, but they're still, they do still happen, as some of you mentioned. So I'm gonna pull this up. All right. So look at your handout and see the before and after. I think it's page 3 of the handout. Okay. So this is just a copy of this in your handout. Okay. But I want everybody, so can you guys see my PowerPoint? Yes? Hello?
Yes.
Thank you. Thank you, Julie. All right. So as I showed you on Monday, a stock split doesn't affect any dollar amounts. And remember, with the stock dividends, when we actually had to do a journal entry for a stock dividend, and we said, and don't worry, we're not going to be doing a large stock dividend in this class. We're going to be doing small stock dividends. All right. So if it's under 25%, you record it at fair market value, which for this class just means the current market price. There's a lot of discussion in advanced accounting of what is fair market value. So the idea is that if it's a little stock dividend, it won't impact the market price. It won't flood the market with more stock and dilute the market price. Okay. So we do a journal entry for stock dividends. We debit stock dividends, just like cash dividends. They get closed to the retained earnings account. Instead of saying dividends payable, we say common stock dividends distributable. So, and that is a stockholders' equity account. And then we put the additional APIC common stock in, because you've got a difference between the par value, $10, and the market value, $15, just like we were selling stock. Okay. They declare it and then they pay it. And then the before picture, I'm sorry, this is the after picture: common stock dividend distributable, paid in capital in excess of par, retained earnings. Here's the before picture and here's the after picture. All right, so now let's look at stock splits. Stock splits reduces the market value of shares. Stock splits reduces the par value of shares. And stock splits increase. So imagine you were sitting down to dinner and you cut your pizza into 6 slices, and then 6 more people walked into the room, same pizza, and you decided to cut each piece in half. Okay. All right. So this is the before the split picture. So we're on page 3 of your handout. You can see it, the before picture. And I simplified the stockholders' equity section of the balance sheet. 600,000 at par, 60,000, $10 par. Just to simplify the problem, I made the APIC account 0 just to make it easy. And then retained earnings 290, total stockholders' equity, 890, outstanding shares, 60. And then after the split, there's no action in the dollars, nothing, there's no journal entry, nothing's happened. And, but look at the description, it's gone because it was a 2-for-1 split. It's gone from 60,000 to 120,000. It's gone from $10 par to $5 par, and the market's going to adjust immediately. But remember, we don't see the market. We never see the market price on the balance sheet. We just see par value and then APIC, which is a historic additional paid in capital when the company sold stock, and outstanding shares. So what happens with a stock split is that earnings per share will change, of course, because you now have more shares. Okay. So what happens in the market? The stock is split, the market responds. Let's say the stock was trading at $80 a share. Right after the split, the market drops to 40. This won't affect the individual stockholder who now owns 2 shares of stock with a total value of $80. And crazy enough, sometimes lowering the price of stock can stimulate trades, which can stimulate demand, which can bring the price up. Okay. All right. And then somebody shared in class that there's a company that's never split. What's the name of that company? Do you guys remember? I think the company, I don't think you guys named this company, but the company that we usually look at is a company called Berkshire Hathaway. Big fancy name, Berkshire Hathaway. And it is, let's just take a quick look. Why not?
It's like 400,000 a share, I think, for the A class stock.
Yeah. Let's see if we can do this. I don't want my inbox to pop up in your guys' faces. So 400, you think it's 400? Does anybody know?
Is that closer to 600?
Let's check. All right, all right, hang on. Yahoo Finance. I don't know their ticker symbol off the top of my head.
It's 485. I just looked. 485,254.
Oh, I might be looking at the wrong one. That's not the right one. Do you know their ticker?
Yeah, it's BRK.A.
Okay, that's the one. All right. Oh, wow. Per share. Per share. All right. Yay. That's a lot of, that's too rich for my blood. All right. All right. So no, some companies don't like to split. All right.
I don't believe Amazon's ever split either.
Amazon? Yeah. What's it trading at, Cole? Do you know?
I could look it up.
You guys who did Amazon? You guys, the team that was your team. What did you guys put on your PowerPoint for Amazon? Let's see. AM.
It was like 3,333 or something. I guess it went down
A little bit. Yeah. That's impressive too. All right. Okay. All right. So retained earnings. We have not talked much about retained earnings. It's net income that a company retains in its business. Net income increases retained earnings. Net loss decreases retained earnings. And retained earnings is part of what we call the stockholders' claim on the total assets of the corporation. And a debit balance in retained earnings is called a deficit. Retained earnings is not cash. Okay. So way back in accounting 201, you guys created the retained earnings statement with me in chapter 2 or 3 for a company called Emerald City Design. And that company, the way I presented the data on that company was that they had just started out. So January 1st, 2014. And so they had a beginning balance of 0. And then they had, for some reason, they made money their first month of business. And then for some reason, they paid dividends their first month of business. And so ending balance. So on the T account, retained earnings, beginning balance 0 plus net income minus dividends gave you the ending balance. Okay. So net income increases, but net losses decrease. So here's Alaska Airline in 2020 when a lot of airlines lost money. Now look at their beginning balance. It's pretty healthy at 5. This is lots of zeros, 5 billion, I guess, but let's just read it as it is. 5,133,000. They lost 1,324,000. They still paid dividends, interestingly. They might have done that quarterly before the COVID virus hit, I don't know. And they ended with a lower retained earnings, but because they had such a healthy balance in retained earnings, it didn't bring them into a debit balance. Okay. Here's another company, Tesla. You guys looked at 2019. Beginning balance was a deficit, 5317832. They had another loss in 2019. This adjustment, so when we do change accounting methods, or if we find out that there was a prior error in a previous year, we often make them in the current year if they're not considered material. If they are considered material, we have to go back and restate all the affected years. But you can see Tesla was running a very high debit balance, okay? And that's not good, right? That's an accumulated deficit. So they were losing money, lots and lots and lots of money, okay? That was 2019. There's how it looks on the T accounts. They also, that adjustment was a credit, okay? This is 2020, beginning balance. They started to make money in 2020. And then here in 2021, they made a huge amount of money. You can see that 5519 there. And they've just now gone into a healthy credit balance. So that they made up all those losses in 2021. So that's truly amazing. Okay. So retained earnings is not cash. Companies can put restrictions on retained earnings. And there'll be things like they'll just make a statement. We're not going to pay dividends out. This money is being saved, reinvested in the company. Okay. All right. And then you guys, the ratios in this chapter, which I did not put on the project. This is just because we were learning about it after the project was due. The payout ratio, dividends declared on common stock, net income. So the calculation is cash dividends declared on common stock divided by net income. So what is of the net income, how much are they paying out to the stockholder? Okay. So in 2015, Nike paid out 27.18% of its net income in the form of dividends. In 2016, they paid out slightly less. So that's a pretty healthy payout ratio. Okay.
Could you go back real quick? Sorry.
Yeah, go ahead. And this is on the 4th page of your handout. Okay. So you can show that calculation there. Okay. So for the 2015, the calculation is going to be 1022 divided by 3760. All right, so let's do this one as a class. Page 4 at the bottom. Okay. So ROE you did do. So to calculate ROE, return on common stockholders' equity, you take net income that's available for the common shareholders. So net income minus preferred dividends divided by average common stockholders' equity. All right. So see if you guys can give me 2015. And remember, to get that average, you take the current year plus the prior year divided by 2. That's why we need the 2014 number. So when you get the correct answer, put it in the chat. So that there. So give me ROE for 2015 and ROE for 2016. Bryce, it's going to be a percent. So it's going to be net income 3760 divided by the average of these two numbers. Okay. And we're going to assume dividends are 0. Okay, I have nothing in the chat. Do you guys need more information? Helena, I got that. Good, you're correct. Julie, you're correct. Can you do 2016? Let's see. Alexis, no, but just direct message me. You're close. We're not quite, I don't quite have those answers clear. Okay, what did I get? I'm getting the wrong answer. Okay. One, two, three. I think you guys are right and I'm wrong. Okay. 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 All right. I am getting a strange number. All right. So here's the answers. No answers. Oh, here we go. 0.38. Now tell me, some of you are getting, a lot of you are getting 3417. What's different here? Is it because did you not round the 12333? So first thing we want to do is we want to average 2 years. If we're solving for 2015, we add these 2015 common stockholders equity plus the prior year, divide by 2, we get 12483, or you might have put 12482.5, which is fine. Then you divide net income divided by that number and you get 30.12. Okay. Over here, 4240, you average these two numbers and you get 34.38. But you guys are getting 34.17. Why is that? Am I doing something wrong? Which one's the right number? I keep getting 34.38.
The reason I got the wrong answer is because I didn't average the two numbers.
Okay, all right, that works. I just wanted to make sure I didn't make a mistake. Okay, so tell me, is this an improvement or is this worse? Better or worse? Was 30%, now it's 34%, pretty big jump. If you had stock in this company, would you be happy? Alexis, yes, you're right. So Zamzam, you're also right. All right, okay. Okay, so I want you to turn in your course pack to page 85. And this is the background on page 85. So you have two columns on page 85. Let's switch out to that. Let's go to the course pack. If I can find it. Okay. So what's happening here is the company is trying to decide, it needs money, right? It needs money. And it's saying, which way do we get the money? We need $5 million. And on page 85, it looks like this, okay? These are not actual data. This is a forecast of data, all right? So if you could turn to that page, and I'm just gonna talk through what's happening here really quick. So you're the chief financial officer, the CFO. You are forecasting next year's income statement, and you need to get $5 million in financing. So chapter 12, we're going to talk about financing in the cash flow statement, and we're going to look at it from a company perspective, from a cash flow perspective. When you borrow money, that's an increase to cash. So when you pay back a loan, that's a decrease to cash. But this year, the CFO is saying we need 5 million, okay? And she or he is trying to decide, should we sell 5 million in bonds? And let's just make it simple and say we're selling it at face value, 5,000 bonds, 5,000 times 1,000 is 5 million. Or should we sell 5 million in stock? Assume a $25 ASP, average selling price. Okay, or 200,000 shares of common stock. The current situation is the company has 100,000 shares of common stock. So if they decide to sell common stock, they would be going into the authorized shares, the unissued shares of stock. They would have to get a vote from the shareholders to do this and the board of directors. And they would go and release these additional shares onto the market, 200,000 shares to get, hopefully to get $25 a share. So those of you that know a lot about stock would know that probably the current price is not 25, but they're projecting that dump in the market will adjust the price to 25. Okay, but for right now, just think of it as 25. Okay, assumptions. Bonds will be issued at a 12% interest rate. And you don't need to know the life of the bonds because you're only forecasting 1 year out. Assume 30%. So what you see on page 85 is a side-by-side comparison. What if we did stock financing? What if we did bond financing? What are the impact? What are the impact on earnings per share? What is the impact on net income? What is the impact on taxes? Okay, so that's what you see on page 85. All right. Let's see. Is that, nope, it's not what you see on page 85. Let's match what you see on page 85. No, oh, I'm going to switch. I wanted to do this twice, but we don't have time. Okay, so let's look at page 85. So I want to walk you through this. So stock, we're just assuming up to operating income, the two scenarios are identical, okay? Up to operating income, the two scenarios are identical because whether you finance with stock, whether you finance with bond, that's not going to change your operating income. Now, remember, things like interest expense are below operating income. So that's where it starts to change. All right, so you can see that. Now, they have an operating income of $3 million. Okay. Interest expense, you can write this in on your course pack. Interest expense is 12%. Okay. So let's do that. Tools. So go ahead and write that in so you don't forget, so you know where that number came from. Okay. And of course, that's going to change, right? It all depends on what's going on in the world. But obviously, we're not getting 12% interest rate bonds right now, but it makes the problem more interesting. All right. So 12% interest. So how did I calculate that interest? Can somebody tell me? It's annual interest. I'm forecasting the whole year. How did I calculate the interest? Okay. Hello, hello. How did I calculate the 600,000? Wacy, correct. 5 million. That's what we borrow. That's what we're projecting we borrow times 12%. That's under bond financing. There's no interest under stock financing. So that's a savings with stock financing. Okay. So that has a direct impact on income before taxes. With stock financing, it's still 3 million. With bond financing, it's now 2.4 million. So bang, drop. Okay. Income before taxes. Tax expense, let's put that in. Go ahead and write that in. That's just an assumption that comes with the problem. And we said, is that 30%? What did I use? No, that's not 30%. How much is it? 840 on 3 million. Sounds lower. %. Sorry. It's a 28% rate. So again, that's something you get with the problem. You don't have to make that up. You just see it there. So 28%. Now compare those two income tax rates. Because we had a higher income before tax with stock, we're going to have to pay more income tax than we would with bonds. Okay. But we still have a higher net income with stock than we do with bonds. Okay. But here's the bad news. Earnings per share with stock, we have 300,000 shares outstanding. With bonds, we only have 100,000 shares of common stock outstanding. All right. We don't have to consider the number of bonds we sold when we calculate earnings per share. So at the end of the day, EPS is much higher with bonds than it is with stock. Okay. For better or worse. Okay. Now, there's another advantage if you do bond financing. You have less shares of stock out there, so you potentially have more control and you have a lower income tax because interest expense is deductible. Dividends are not. And I think I shared with you guys that at one point they were trying to make dividends deductible and it got rejected. Okay, so that's a side-by-side, whether you should do stock, whether you should do bonds. Okay, so there's trade-offs. You've got to pay that interest. That's cash outflow. You don't have to pay dividends, but many companies do pay dividends, but not all. Okay, questions about that? All right, okay. I'm gonna stop sharing and then we're going to turn the page to cash flow. And so stay in your course packs. I'm just going to switch PowerPoints here real quick. And your chapter 11 homework is part 2 is due tonight, and your quiz is due, I think, Sunday night. And it's looking like I do have a computer lab. So let's take a look at the calendar, if I can bring it up. Let's see. So I have scheduled a computer lab for Monday. Not this Monday, next Monday. So next week we will be on, so chapter 11 homework is due tonight. Your critique of your PowerPoints. Did anybody have trouble finding the PowerPoint? So you go to our class and see if I can do student view. And you come down and you go to files. And you go to class presentation for critiques, and you find the PowerPoint. And if there's also notes, make sure you pick it up. So Lulu has 2, and GM has 2, Amazon has 1, and you will look at their PowerPoint presentation and look at the notes that you took on Monday and do your critique. And the critique is under, I think it's under chapter 11, but it's also under projects. So critique of another team's presentation, and then you'll just answer these questions. It's called a survey. You'll fill it out, and you're answering basically the same questions that you took notes on in class. Okay. Any questions on that process? So let's go back to the calendar, leave student view. Maybe. So so today, a little bit today and all next week, we are going to be really hitting cash flow. And then Monday, I will issue you your practice exams, or you can print them out for the final exam. I don't think they're ready to be printed yet. And Monday, we will meet in room A130. And we will do the retirement lab together. And that's a computer lab, and it's got Excel. All right. Okay. Let me bring up chapter 12. Okay. Can you guys see the PowerPoint for chapter 12? Yes, no?
Yeah.
Thanks. All right. I have a lot of favorite chapters. The bond chapter is one of my favorites, and the cash flow chapter is one of my favorites. So what we're going to do is, in this chapter, we have 5 learning objectives. What is the cash flow? Why is it even a useful statement? Some people say it's the most important statement. I tend to agree with that. If you don't have cash, is like oxygen for a company. So if you don't have cash, you don't survive. There's 3 major sections to the cash flow report: operating, investing, and financing. And then typically in the SEC reports, you don't see this, but in a classroom cash flow report, you would add a non-cash, significant non-cash events as a footnote right on the cash flow statement. In practice, they usually put it in the notes to the financial statements. You'll look at a company's cash flow, assess it for healthiness. You'll learn how to prepare one. I tell students now that you should plan about 40 minutes in the final exam to prepare cash flow. So I teach it very step by step, but it's a long report. And you are not responsible to know the worksheet or the direct method. We use the indirect method. Okay, and then product life cycle and cash flow. And some of you alluded to that in your presentation, so I know you were looking ahead on that. So the cash flow primary purpose is to give the reader information about cash receipts, cash payments, net change in cash. Did it go up? Did it go down? From last year to this year, did it go up? Did it go down? And it's those three areas. So way back in chapter 1, we said companies do three things. They do operations, which is your basic business. They also do investing. Maybe they buy property, land, building, property, plant, and equipment, which stands for property is land, plant stands for any building, whether it's a factory or a manufacturing plant or a store, and equipment, okay? And financing. And so stock versus bond financing, how that works. And all of those things make cash go up or make cash go down. So in this chapter, unlike what you've been studying for 11 chapters, which is accrual accounting, in this chapter, we are studying cash accounting. Did it have an impact on cash? Which means, did it go up or did it go down, the cash account? All right. So here's a cash flow report. And if you have your course pack open, this is way over on page nowhere. You're gonna create this. I don't think I gave it to you, but this will be the final cash flow for this discussion. But I just want to, for now, draw your attention to the three major areas of cash flow: operations, investing, and financing. So I just told you that the cash flow report is all about cash. Cash goes up, cash goes down. Okay, so we do not use language like there was a loss or there was a gain. Okay, so instead we say cash was provided or cash was used. Okay, so if this number is a positive, that means cash came in, more cash came in through various methods. One method is net income. Okay. And then you're going to see some funny things here: depreciation, loss on sale of equipment, decrease in accounts receivable, decrease or increase in accounts payable, increase or decrease, receivable, prepaid, accounts payable. And that doesn't make sense right now, but all of these adjustments are basically taking this income statement, 139,000, this net income that came from the income statement. All of those adjustments are looking at balance sheet accounts and saying, we accrued an expense, but since it didn't have any impact on cash, we get to reverse it, because it doesn't count on the cash flow statement until we actually pay the bill. So things like depreciation, we paid for the equipment maybe 5 years ago. And so on 5 years ago cash flow statement, you would see purchase of equipment, cash going out. But depreciation, as far as cash flow is concerned, is a nothing. It didn't happen, because what is the depreciation journal entry? Debit depreciation expense, credit accumulated depreciation. So it's really looking at the accounting from a cash system basis. So that's kind of unraveling everything we've learned up till now. And we need the cash flow report because we need to know how we're doing on cash. It's a way of looking at the data and saying, are we sustainable? Are we generating enough cash? So here where you see these negative numbers, that isn't a bad thing. So this is all about investing. And the big thing here is they purchased a building, they purchased some equipment, and then they sold off some equipment, some old equipment. Okay. So when cash is negative in investing, it means that company is reinvesting in the business in some way. Okay. So we want companies to reinvest in the business if they're going to be in business for the long haul. Okay. In financing, it will be negative when we pay dividends. It will be positive when we borrow money, like bonds. When we issue bonds, cash will go up. When we pay the bond back, cash will go down. And it will be positive when we issue more stock. So we sell stock, cash will go up, and it will show here under financing. All right. Okay. So I'm going to jump over to the product life cycle, and I just want to introduce this today, and we'll review it on Monday. All right, and remember, Monday we are in our regular classroom, but a week from Monday we're in a computer lab. Okay, how many of you have studied biology? Just put a yes in the chat if you've studied biology. And for some reason you decided to be business majors. Well, anyway, I think biology is cool, but in biology you have a human life cycle, and you have conception, which we would call here introductory phase. You have growth, your growth year. Some of you are probably still growing, depending on how old you are. You have maturity, which I guess that's me, or maybe I'm in decline. I don't know, one of those. Decline is as you head out to the next life, okay, as you pass. So products do the same thing. Those product life cycles can be really, really short, okay? Or they can be long, depending on the product, okay? So when we look at an introductory product, can you guys throw something in the chat? What's a brand new product that's coming out? And yes, it can be a service too. So throw in a brand new product that's new in the last year and a half.
iPhone 13.
Which one, Peter? iPhone 13, is that what you said?
Yeah.
Yeah, okay. So when did the iPhone 12 come out? Anybody know? Has it been like 2 years or longer? I have a 7, just letting you know. Okay. All right. So introductory phase, you are just releasing this product to market. And who buys products in the introductory phase? Not everybody, particularly technology products. So in an introductory phase, we have a consumer title called an early adopter. And early adopters love new stuff. They want to be the first one to try a new product. They might even be have a relationship with a company and actually get free product to beta test. Or now a lot of the beta testers are influencers on like Instagram, and they can actually talk about the product in plus or minus, favorable or unfavorable about the product. But most people aren't buying the product. So when we say introductory, we're really looking at the early days, years, months of a product, okay? And what's happening is you're seeing a sales pattern here. It might be going up unless it just fizzles and dies, but it's gradually getting traction, and more and more people are going to be buying it. But in these early phases, sales are low, and so cash, what you see on if you were to assume a company had a cash flow statement and they only sold one product, you would look at that company's cash flow statement and you would see a very particular pattern. Cash from operations would be negative. Cash from investing would be negative. Cash from financing would be positive. Now, when I use that language, negative and positive, I just mean like a number. I don't mean favorable or unfavorable. So let's go back to the cash flow statement. That means cash from operations would be negative. Cash from investing would be negative, which it is in this case. Cash from financing would be positive. That's when a company is in the introductory phase. Okay, so let's go back and look at these patterns. Operations is negative. So what does that mean? It means they're not generating enough cash. They're not generating enough cash to support their business, which we saw with Tesla, with losing all that money. They're not generating enough cash. And then they took off and made the big sales in 2021 and turned it around. So they know they have a good product. They're releasing it, but the sales volume isn't there yet. And that's why net income is a net loss, and that's driving cash from operations negative. However, cash from investing is negative, which means they're investing in the company. So cash is going down, they're investing in the company. Cash from financing is positive, which means they're either borrowing money from investors who believe in the product, or they're selling stock from stockholders who believe in the product. Okay. So does that make sense? So if you see this pattern on a cash flow statement, you would say that company's in the introductory phase. Okay. Growth phase means sales are going up. So when we talk about introductory, we're saying, think of a number line. Sales are growing, but not very much. And now sales are really growing. Okay. So at this point, cash from operations is starting to be positive. Maybe not a lot yet, but positive. Okay. All right. Cash from investing is negative. Why? Because they need to keep investing. So maybe they need to open another factory to meet demand. Maybe they need to buy more equipment to meet demand. And cash from financing is also going to be positive, which means they're borrowing money. Okay. So if they're borrowing money, debit cash, credit bonds payable, or debit cash, credit common stock. Okay. Maturity, that's when sales and production level off. So demand is meeting supply. Okay. That's when companies make a lot of profit on a product. Okay. Cash from operations is exceeding its investment needs. So that's when they're making the big bucks. Cash from investing is neutral. The company's not going to reinvest. They're not opening new factories. They're not buying more equipment. They're meeting demand with what they have now. And now at maturity, we start to see cash from financing to be negative. Now they're paying dividends. Now they're paying back the bonds payable or other loans that they have. Okay. And finally, the decline phase. Sales and production start to drop. Oh, the iPhone, what is it, Peter, 12 or 13? I think you said 12. So now we're saying, oh, the 11, the 12's coming out in 2 months. The demand for iPhone 11 goes way down. Now that's also a good time to buy an iPhone 11. Now cash from operations declines. Why? Because sales are going down. Cash from investing can possibly become positive. You might be in a company that's really discontinuing a product line. They might be closing factories, selling off equipment, selling factories, selling real estate. Cash from financing is probably negative as well. Because again, the stockholders and the lenders are saying, we just expect dividends. You know, you have this profitable product. You might be in decline, but you're still making money. Now, a product can get to maturity and then it can be reintroduced, or they can add a few features. And I would argue that with the phones, that's what's happening. But anyway, I wanted to stop there. And we'll look at some cash flow statements on Monday and see if you can identify what phase they're in. Okay. All right, you guys were really quiet today. I think you're still tired from the paper. All right. So have a really good weekend, and I will see you on Monday.
Bye, thank you.
All
Goodbye.
right,
Thank
good to
you.
see you. I'm going to stop recording.